Hello, and welcome to the world of accounting and finance. My name is Dr. Annette Moultrie, and I got you covered. Whether you are a seasoned professional or someone who's just willing to learn accounting and finance, I've got you covered. So please hit the subscribe button. Click on the notification bell so you'll be notified of upcoming videos. And if you have any accounting or finance questions, please post them in the comments below, and I will respond to your questions. Again, thank you for watching. Hello, in this video, I will start with the discussion of completing the accounting cycle. Completing the accounting cycle. The learning objectives are: prepare the financial statements, including the classified balance sheet. 2, use the worksheet to prepare financial statements. 3, explain the purpose of, journalize, and post closing entries. And 4, prepare the post-trial balance. Of course, all of these objectives will not be covered in this video, but it will be covered in the next video. This is part 1. The other objectives are: 5, describe the accounting cycle. 6, use the current ratio to evaluate business performance. And 7, explain the purpose of, journalize, and post reversing entries. Again, this is part 1 of this video. So the learning objective, starting with 1, is prepare the financial statements, including the classified balance sheet. Once the adjusted trial balance is compiled, the next step involves the preparation of the financial statements, which are arranged in a specific sequence. You have the income statement, the statement of owner's equity, and finally, you have the balance sheet. The income statement delineates revenues and expenses, culminating in the computation of net income or net loss for the designated time frame. Now, following this, the statement of owner's equity, it illustrates the alterations in owner's equity over the period, for reflecting owner contributions, net income or net loss, and owner withdrawals. Concluding the financial reporting process, the balance sheet, it provides a snapshot of the company's financial position as of the period's conclusion, whereas it presents assets, liabilities, and stockholders' equity. Now, this comprehensive overview, it offers stakeholders valuable insights into the company's financial health and the company's performance. The income statement or balance sheet statements. Now, for each account listed here, you identify whether the account would appear in either the income statement section or the balance sheet section of the worksheet. Assuming normal balances, identify if the account will be recorded in the debit or the credit column. So here you see you have service revenue. Of course, service revenue is included in the income statement and it shows as a credit. In the accounts payable account, it shows up in the balance sheet. The balance sheet, and it shows as a credit. The cash account shows up in the balance sheet also, but you know cash is identified as a debit. In the depreciation expense account building, it will show up in the income statement section of the worksheet, and it shows as a debit. Withdrawals and accumulated depreciation will show up in the balance sheet of the worksheet, and it shows as a debit for withdrawals and accumulated depreciation building. It will show as a credit. So the service revenue account, accounts payable account, cash, depreciation expense, withdrawals, accumulated depreciation. These are accounts that will show up in a financial statement. Now, the financial statements will be prepared from the adjusted trial balance. Now, each account on the adjusted trial balance will be used on only one financial statement, except Bright Capital, which appears on the statement of owner's equity and the balance sheet. And here you see Smart Touch Learning, the adjusted trial balance, ending December 31st, 2024. So here you see, let's start with number one, the income statement accounts. That will cover the service revenue, rent expense, all the expenses, depreciation, building furniture, interest expense. All of this will show on the income statement account. Now, the statement of owner's equity, you will have, of course, the capital of the company's capital and withdrawals. And the balance sheet will cover all of these accounts that you see here. Relationships among the financial statements. The income statement's net income, it boosts owner's capital, while a net loss, it diminishes it. The final owner's capital figure transfers to the balance sheet, ensuring that total liabilities plus owner's equity align with total assets, thereby upholding the accounting equation. Now, this process is depicted in the subsequent 3 slides that you'll see. And here they are. Well, here's one of them. Exhibit 4.2. Now, you know that we always prepare the net income statement first. The net income or net loss from the income statement will flow to the statement of owner's equity. Here you see is the income statement for Smart Touch Learning, 2 months ended December 31st, 2024. So here you see the net income at the bottom, 8,550, which will show on the statement of owner's equity. This other exhibit shows the statement of owner's equity. And remember, the net income that we talked about earlier is showing up on the statement of owner's equity. And the ending value of Bright Capital flows from the statement of owner's equity to the balance sheet. So this number that you see here, 51,550, will show in the balance sheet. And here in this exhibit, you see is the balance sheet for Smart Touch Learning. The ending value of Bright Capital from the statement of owner's equity is reported on the balance sheet. So Smart Touch Learning's balance sheet that you see here, it lists the assets on the left side and the liabilities and owner's equity on the right. Classified balance sheet. A classified balance sheet organizes assets and liabilities into distinct categories, delineating between current and long-term items. Liquidity, denoting the swiftness of conversion to cash, it serves as a benchmark for assessing an asset's usability. Accounts receivable, for instance, exhibits relatively high liquidity due to their prompt collection nature. Conversely, office supplies possess lower liquidity, with furniture and buildings ranking even lower on the liquidity spectrum, necessitating more time for conversion to cash or depletion. Now, this hierarchy reflects the varying degrees of accessibility and usage potential across different asset types. Assets. What are current assets? A current asset is an asset that is expected to be converted to cash, sold, or used up within the next 12 months or within the business normal operating cycle if the cycle is longer than a year. Now, the operating cycle is the time span during which cash is paid for goods and services, which are then sold to customers from whom the business collects cash. Long-term assets, on the other hand, it encompasses assets that will not be liquidated or depleted within the business operating cycle or a year, whichever is longer. A long-term investment entails holdings in bonds or debt securities or stocks, equity securities, intended for retention for over a year. You have plant assets. Plant assets constitute enduring tangible assets like land, building, and equipment integral to business operations. In contrast, intangible assets possess no physical presence, but derive value from specified or specialized rights they confer. Now, these include patents, copyrights, trademarks, or even goodwill. Liabilities. What is current liability or current liabilities? Well, a current liability is a liability that must be paid with cash or with goods and services within 1 year or within the entity's operating cycle if the cycle is longer than a year. A long-term liability is a liability that does not need to be paid within 1 year or within the entity's operating cycle, whichever is longer. Owner's equity. Owner's equity embodies the owner's entitlement to the business assets, reflecting their contributions, the net income or loss incurred by the business, and any withdrawals made by the owner. It signifies or represents the residual value of assets remaining after all liabilities have been settled or paid. Here you see an exhibit of the classified balance sheet. Now, the classified balance sheet includes categories for current assets, long-term assets, current liabilities, and long-term liabilities. So here in this exhibit, you see a report form which lists the assets at the top and the liabilities and stockholders' equity below. Now, this report form, it is more popular in practice than the account form that you saw in Exhibit 4.2. Learning objective 4.2, use the worksheet to prepare financial statements. Use the worksheet to prepare the financial statements. How could a worksheet help in preparing financial statements? How could a worksheet help in preparing financial statements? Well, the income statement section exclusively contains revenue and expense accounts. You would transfer the revenues and expenses from the adjusted trial balance section into their respective columns within the income statement section. 2, the balance sheet section comprises asset and liability accounts, along with all equity accounts except revenues and expenses. You would transfer the balances of these accounts from the adjusted trial balance section to the appropriate columns within the balance sheet section. Third, you will calculate the net income or net loss by subtracting total expenses from total revenues. Then you would input the net income or net loss as the balancing figure in both the income statement and balance sheet sections. Now, if there is a net income, you enter the balance in the debit column of the income statement section and the credit column of the balance sheet section. If there's a net loss, you enter the balance in the credit column of the income statement section and the debit column of the balance sheet section. So the first 4 sections of the worksheet, it helped determine the adjusted trial balance from which we prepare the financial statements. In section 5, you have the income statement. Section 6, the balance sheet. Section 7, determine the net income or net loss. And here in Exhibit 4-4, it shows the net income adjustment in the debit column of the income statement section, and the adjustment in the balance sheet section as a credit. Learning objective 4.3. Explain the purpose of journalize and post-closing entries. So what is the closing process and how do we close the accounts? To isolate each period's net income from that of others, revenues and expenses undergo closure. In other words, you close revenues and expenses. Now, this process, integral to the accounting cycle's conclusion, it involves journalizing and posting closing entries at the period's end. Now, its objective is to reset the balance of revenue, expense, income summary, and owner withdrawal accounts to zero in preparation for the subsequent period. So in other words, the closing process zeroes out all revenue, all expense accounts in order to measure each period's net income separately from all other periods. The temporary accounts include revenues, expenses, income summary, and owner withdrawals. It pertain to a specific accounting period and are closed at its conclusion. So temporary accounts relate to a particular accounting period and are closed at the end of that period. Permanent accounts. Permanent accounts such as asset, liability, and owner capital accounts. It remains open beyond the periods and serving as a continual record of the company's financial position. So in other words, permanent accounts are not closed at the end of the period. And that includes your asset, liability, and owner capital accounts. So what is the closing process and how do we close the accounts? This is the second part of 3. So closing entries facilitate the transfer of revenue, expense, and owner withdrawal balances to the owner capital account, ensuring the company's books are printed, or not printed, but primed for the upcoming period. Consequently, this transfer aligns the owner capital ledger account with its balance as reported on the balance sheet. As an interim measure, revenues and expenses may initially move to an account termed income summary, okay? Acting as a temporary repository, the income summary account, it serves as a conduit for the temporary storage of revenues and expenses before their ultimate transition into the owner capital account. Moreover, it functions to consolidate net income or net loss for the period. So again, the income summary is a temporary account that summarizes the net income or net loss for the period. So closing the revenue accounts It involves debiting each revenue account for its existing balance, while a corresponding credit is made to the income summary account. Subsequently, each expense account is credited for the amount of its debit balance, with a matching debit recorded in the income summary account. Now, this process results in zero balances across all revenue and expense accounts. The balanced income summary account, it reflects the net income or net loss for the period. It is then closed by transferring its balance to the owner capital account. As for the owner withdrawal account, which typically holds a debit balance, it is closed by crediting it for the balance amount. A corresponding debit is then recorded in the owner capital account to complete the closure. And here again is the closing process, as you see on the screen. These are the steps that I followed. Starting with the revenue account, you close it to the income statement. I'm sorry, you close it to the income summary. Okay? Then you have your expenses. You also close it to the income summary. And then in step 3, you close to the owner capital. Step 4, you see the owner withdrawals, but the owner withdrawal is closed to the owner capital account. Okay, so this is the end of part 1. This is the end of part 1. So please watch out for part 2, where we will begin the discussion on closing temporary accounts, net income for the period. And hopefully we'll cover the other objectives in the next video. So again, this is Dr. Moultrie. I hope this video has helped you in understanding the accounting cycle. Thank you for watching.